Alright, we're reviewing the 102,000 USD stock portfolio. Mind you, I'm a Canadian citizen, so that's 133,000 CAD. I want to talk a little bit about yield on cost. We're going to review some of the individual positions. Ladies and gentlemen, I look so forward to breaking this down for you, so let's just jump right into this.
Drop it.
Welcome back, my passive income investors alike, to the stock portfolio review. We're going to come back to the pie chart and some of the further updates at the end of this video, but I want to talk to you about some of the individual accounts first. First, we're going to look at the tax-free savings account. My favorite account of all time. Many of you know it is a 100% tax-free income account. This account has better perks than some of the accounts you guys have in the US, and I recently just crossed over $100,000 as of this year in this account. The minimum limit you are allowed to contribute to this as of 2020 is $69,500. So I'm up well over $30,000 in capital gains in this account alone. And the reason I want to show you this isn't to brag, but it's to show you how fast yield on cost can change. If we go into the dividends, and we're going to come back to the individual positions to review, but taking just a look at the dividends, if we take 2,128 US and we convert that to CAD, we're looking at roughly just under $2,800. And then if we add the 2,000 CAD, we're looking at it right around that $4,800 mark. And if we go into the percentage value, I did the exact amount here, was $4,786, and we divide that out between the original amount contributed, we're looking at a yield on cost of almost a 7%. That is a dividend income of 7% on the money I made and put in this account. And I'm holding some pretty incredible companies here. We're talking about companies like Apple, companies like Microsoft, and a lot of people get confused and think it's really hard to get these kind of yield on cost, and it is to an extent, because you do need some good growth capability in your portfolio to get you to this level. Because as some of the more speculative positions I owned grew, I had to leverage some of them down, and then I started diversifying them into other stocks. In fact, I even did that with Apple recently last year. I had a lot of money in Apple. I scaled it down to kind of re-leverage it into other positions, though I wish I held on to it, because obviously Apple's at some obscure highs right now. Now, taking a look at the performance of this specific account, it's starting to mind boggle me just a little bit, considering this account isn't even 3 years old yet, and we're already seeing a rate of return of 89.49%, representing just around a 30% return a year. I don't know how to explain this, and it's something that I tend to overlook, but I think it's something to celebrate and it's something to share because it's a pretty incredible feat considering the short amount of time. But also remember, the markets have been doing insanely well, and you could pretty much throw anything at a dartboard and achieve some okay results. But mind you, let's take a look at the individual positions themselves and see what's going on, because as I've said, I'm extremely happy with where all these positions sit, and at the end of this video, I'm going to share with you some of the positions that I'm looking to add to this portfolio. Mind you, I will be doing a further breakdown on that a little bit later. But taking a look here, guys, we have all the Canadian positions, which don't do anything at all. The Canadian markets suck. That's why I mainly focus on the US markets, considering I've been holding some of these companies for a very long time, and the overall Canadian positions are only up 1.7%. So we can really tell this isn't making up for the 30% returns we're experiencing here. It's more or less on the US side of the border. Taking a look at those companies that I focused on last year, like MO and BTI, doing still insatiably well with their dividends of over 6%. Apple and Microsoft obviously leading the way in this portfolio, just crushing it. And then we have my utilities like Southern Company, which I kind of just leave on the back end burner, don't really pay attention to it, but it's done pretty excessively well in its own little crevice. Now, moving on to the other parts of the portfolio and the other 3 accounts that I have, looking at the managed account, I'm not going to be doing much with this year. I got MO sitting in here. I got some cash sitting in here. I might have to pull out some MO to pay my taxes, but I think I'll be able to get away with it without touching this account. So I'm just going to leave this sitting here for now and just let it do its thing. I don't plan on, throwing money at this. I plan on throwing money at my Royal Bank account, which we'll take a look at in a sec, but I want to go over the RSP real quick because this makes up one of my favorite holdings. I've recently really fallen in love with Johnson & Johnson. I think people really underlook this company, even though I'm up only 4.5%. I love the company because of the products they sell. Most people think Johnson & Johnson's just pushing opioids. It's something that I mainly focus on as one of my drug sector portfolios in the healthcare sector, I should say. And the reason I like this company so much is because people overlook the fact that this company deals with products like Tylenol. They deal with personal care like tampons and other things that are just pretty much necessities to life, and they own some of the best brands. And I'm thinking about leveraging more money even into this stock alone in my RSP. I got a little bit of money. I don't want to contribute any more money to my RSP, so what I might end up actually doing is taking some of the money out of my TFSA here, and I'd really like to get Johnson & Johnson, or at least a bit of it, in this account in and of itself as well. I believe Johnson & Johnson, Apple, and Microsoft make up my three favorite holdings because they sit in the S&P top 10 review of the RBC account. Now, this account, believe it or not, is the one that I'm going to be focusing heavily on coming into this year. I opened up this account to basically keep track of my my line of credit because the Royal Bank was the only bank at the time that would approve me for a line of credit, just to build, my credit score. Not that I'm ever going to use the money. They gave me about 20 grand, which is just sitting in the account. But I figured I'd open up another trading account as well. And this account gives me roughly the same perks as Scotiabank. So I'm going to be focusing on building up this whole new position in a whole nother bank account. And it's going to be fun to watch. So essentially right now we mainly hold BTI and MO in this account. And you guys are going to be getting to hear a lot about this account soon. But I'm going to come back to this a little later. So let's just head on over into the pies themselves and see what's going on in here and what I plan on doing. So first of all, like I said, I'm pretty much happy with where all my current positions sit. I do not plan on re-leveraging them around or doing anything of that nature. I'm just going to let them do their thing and start focusing on adding some new positions to the portfolio. We can see the average dividend is about $450 a month. Really, really incredible stuff here, guys. And we're taking a look at the overall spread. It hasn't changed at all. We can see that, consumer staples like your MO and your BTI, those high yielding dividend stocks, make up the good chunk of my dividend income. And I'm okay with that. Mind you, Johnson & Johnson is the 6%. It's the healthcare, little lower one. And I'd like to see that expand a little bit more just because it sits in the S&P top 10, which brings me to my next point of some positions I might consider adding, guys. Now, with these new positions I've been looking at, I've been struggling deeply in these markets sitting at all-time highs, which makes it very hard to find good stocks out there. And I'm going to be making a video on dividend stocks that I think would be considered worth paying attention to. But because I want to start focusing on core value stocks to the portfolio, as I'm pretty happy with where the dividends currently sit, I'm trying to find those S&P top 10 companies. Now, with the S&P top 10 companies, we're kind of limited on options because I'm primarily a dividend investor. I only really want to own the ones that pay dividends, preferably the higher dividends, and there's just not many of them. So of the S&P top 10s that pay dividends, we have Apple, we have Microsoft, we have JP Morgan, we have Johnson & Johnson, and Visa. Visa is one I have paid heavily attentive to. Sorry, that was really confusing. I pay a lot of attention to Visa, but the problem is the dividend isn't that high, and because I plan on holding these for my lifetime, I do want these paychecks coming in. So that's why I ended up adding Johnson & Johnson, which is just an incredible company. Like I said, I'll probably do a full breakdown on it, on things you should probably know about it. But the next company I'm paying most attention to, guys, is JP Morgan. JP Morgan Chase, it's not the of most favorited banks. There's a lot of people out there that are more into companies like Goldman Sachs, but because JP Morgan sits on the top 10, it has an incredible rate of return and performance, and it's another bank that I would like to add to my banking sector. As if we go back into the overview of the pies, and we can see that financials are really only making up about 18% of my current dividend income, and they only make up about 14% of the overall pie in and of itself. So I'm thinking about expanding on my financial sector just a little bit more to try and bring that dividend up to closer to probably about a 20%, and then including, because financials are just a little bit more stability to them. They're backed by the Federal Reserve here, the Canadian Treasury, and they don't get a lot of movement on the Canadian side because, as I've said, my Canadian stocks just haven't been growing on the financial sector side, and they've been relatively flat. Mind you, these Canadian banks are paying out really fat dividend yields. If we go back into the dividends there, sorry guys, we head back into the dividends, we can see these banks are paying out 4.7, 4.93, and obviously JP Morgan, it pays out a 2.6% dividend, but at the same time, it seems to be one of those growth stocks in the financial sector. Taking a look, it's actually one of the best growth positions in the financial sector, and the PE is at a relatively reasonable base of about 13. Is it a little overvalued here at the current price point? Yes, but at the same time, if it takes some dips, I wouldn't mind cost averaging into this at some point in the near term future. I am keeping my eyes open on other banks, and I'd love to know what you guys think about this bank in the comments section below. Other than that, I'm not going to be venturing into too many lower cap risky companies. I might continue to leverage into some of the stocks that I have, but in the meantime, I would love to know what you guys think about all of this stuff in the comments section below. I'm also using this chart as of recent, which I'm going to update you guys on very soon here, is my dividends received. Now, this is part of the portfolio I'm using to track all of my dividends, my working income, along with my personal expenses. And I wish I had this tool last year because I'm just doing my taxes for last year, and I've realized, you know, if everything was just sitting in here, I wouldn't have to be scrounging through an endless amount of credit reports and receipts. I could just stack my receipts and then document it all here. So recently, last night, I took a couple hours and I just started going through some of the expenses, adding them up, and I can't believe how much this chart saved me. It's just an iCloud numbers chart that my friend Matt Money put together, put a lot of work into it. If you guys want to take advantage of this, you can access it on your phone anytime, anywhere, and it's only 12 bucks, guys. I highly recommend it. I'm not going to pump you up anymore here. I hope you enjoyed this video. Stay cool, stay awesome, guys. I look forward to chatting to you real soon.